All right, time to review our top 7 predictions for 2024 and to make our top 7 predictions for 2025. Did we knock it out of the ballpark or did we horribly fail? Stay tuned, let's find out. Welcome to the Moving to Idaho podcast, your insider's guide to Idaho's exciting real estate market and the lifestyle that comes with it. Whether you're buying, selling, investing, developing land, or just dreaming of life in the Gem State, we're here to bring you the latest market insights, expert tips, and local stories that make Idaho one of the most sought-after destinations in the country. Join us as we explore the towns, neighborhoods, and communities that make Boise and the entire Treasure Valley more than just a place to live, it's a place to thrive. From market trends to hidden gems, we are your go-to source for all things Idaho real estate. You're listening to the Powell Group, and we know Idaho. Let's get started. Okay, so we always like to start our year's first video with a review of the previous year's predictions to see, did we know what we were talking about or were we horribly wrong? Let's take a look. We had 7 predictions. Number 1, would there be a crash or not? We don't think so, we didn't think so, and guess what? We didn't have a crash. Fundamentals do not support it. Of all the homes owned out there right now, 40% of them have no mortgage at all. And then you take the 60% that do have some sort of financing in place, and almost 80% of those guys have mortgages under 5%. So the fundamentals simply just don't support it. We got people with great credit buying houses with very low rates. There's no way, short of another pandemic or another Great Recession, to shake loose so much inventory that we have more inventory than we have buyers for. So because inventory is so tight and it is not exceeding the demand we have from the buyer side, prices are staying in place. Actually, they have actually come up some. We'll get into that in a little bit. Number 1, no crash. That was perfect. Number 2, interest rates. We had 2 parts of that prediction. We thought there would be between 5 and 6 cuts by the Fed, mostly in the back half of the year. That turned out to be wholly incorrect. There was only 3, so we screwed that one up. The other guess was that rates would be between 5.5 and 6.5. Now, that's partially right because certainly for a good part of last year, rates were below 6.5%. But not long enough to really say, yeah, we nailed that one out of the ballpark. The bond markets did not react the way we anticipated them to once the Fed started cutting, so rates stayed high, and rates are still high. Matter of fact, as of this morning, they're over 7%. So, that's going to be another prediction we will keep in the mix for 2025. All right, so our third prediction was inventory. We predicted we would have more inventory in 2024 than we did in 23, and that was 100% correct. The last estimate that I saw by the National Association of Realtors, which came out at the very end of November, very beginning of December, was for a total of 4.17 units sold. That was the pace we were on coming out of November. Now, the last 2 weeks of December really slowed down, actually shut down, to be honest, because we had Christmas and New Year's Day both on a Wednesday in the dead middle of the week. And whenever that happens historically, and I'm going back on over 20 years experience in the market now, that when you have that holiday land in the middle of the week, those 2 weeks they got shot. Everybody's got holiday on their mind. It's not like when it's on a Monday or a Thursday or Friday and you're just losing a couple days. When it's in the dead middle of the week, you effectively lose more than you normally do. And the traffic, not just in our listings, but with other brokers we talk to here in the Treasure Valley, and also other agents we deal with all over time, all over the country, everybody saw traffic drop off significantly the back half of December. So we'll see if that 4.17 number stays being a real number, or if it comes down to, say, 4.15 or 4.14. But we definitely broke 4 million units, which was the goal, because 2023 being the previous year, based on the predictions, we sold less than 4 million units in 2023. We broke 4 million in 2024, so that one's correct. Number 4, buyers. We said that we would see more buyers in the market, and we certainly have. You can't have more inventory sold without more buyers in the market. So I don't want to spend a lot of time on that one. It was easy. Quite honestly, we'll think we're going to be seeing more buyers in 2025 as well, but I'll go into the weeds on that, if you will, in the predictions for 2025 in the later part of this video. After that, number 5, more sellers. Again, easy thing to guess on because we were going through people. We had a couple things happening last year. Most of them have shaken out here in the Treasure Valley. Other areas are dealing with it more in 2025 than we will be, but the back to work thing. We had so many people working from home that We saw in the very early part of 2024 that Google, Amazon, just all the big tech companies that had given a big work from home permission, if you will, for all their people to go out and buy wherever they wanted to buy and work wherever they wanted to work, that got rescinded. And we started to see a lot of people, they had to move back to the Bay Area or wherever their company was, because the company had said either A, you're going to be fired if you don't come back, or B, you are going to not be, like Amazon said flat out, you're not going to be considered for promotion and you're not going to get any raises, and it's all stick, no carrot at this point. Interesting thing for 2025, and I don't want to get too deep now, but supposedly, and I haven't really dove into this, but supposedly the vast majority of the federal workforce is working from home, not working in the offices, and that might just be a Washington, D.C. thing for the agencies based up there. But supposedly there's people working all over the country right now from home, and the Trump administration has clearly said they're going to have everybody working at the office, wherever that office may be for the agencies. So I don't know what that's going to bring. If he actually can execute that, I say if the administration can execute that, you might see more of what we saw with the return to work for the tech sector start rolling over into the Fed sector. And I just don't know how many people, it's not millions and millions of people, but I just don't know how widespread that is and how it's going to affect all the markets. And I don't know that it's going to affect Boise and the Treasure Valley at all, but it's something to look for on a national basis. So we are going to see more sellers. The 5Ds will drive it, as it always does, and we'll get into that later on. And you saw from the clip that we had earlier. Definitely going to have more sellers, going to have more units, and prices will be good. So that's what that was. The next thing we did, point number 6, was AI and how AI was going to affect real estate overall. And our predictions, we talked about copywriting. We talked about really going to be an impact on the rent side, which we did see as they're using AI to gather data to approve tenant applications based on all the database in the different FICO modules, things like that. So that came to fruition. But again, that wasn't a hard prediction. Where it goes from here, we're going to see, because it actually did penetrate further than we thought. But in our predictions for 2025, we'll go deeper in that. And then the last one we want to talk about is pricing. And we did predict prices would come up marginally. Looking at the national numbers, we're up about 5.2% across the board in the country. And if you look here in the Treasure Valley, about 4.8-ish, and that's blending in Ada County, Canyon County, the surrounding counties, both new construction and resale all together and lumped in. But I'll do a whole different video later this month on how 2024 shook out. And I'll dive down into the different counties and whether it was resale or new construction on that. All right, so recapping our misses, which I hate doing, but it is what it is. On the interest rate prediction, we were correct on where we thought the rate would land, but it wound up actually higher than that at the very end of the year when we broke 7 in December. But we missed the number of rate cuts miserably. We thought there'd be 5 to 6, all in the back half of the year. We only got 3, so that's a miss. The other one we missed on was the sales, the unit sales. We knew that it would be north of 4 million. We thought it would be between 4.25 and 4.5, and it only came up somewhere between 4.15 and 4.17. It's still more than 4 million, which we wanted because 2023 was less than 4 million. So in the right area, but not the right number. So that one was a miss too. So with all that said and out of the way, let's go back and start talking about our top 7 predictions for 2025. The first one I want to talk about is interest rates. The 5.55 to 6.5 range, I still think is going to be realistic for 2025, but it's probably going to be more like 5.75 to 6.75. The key thing we have to watch for, and that could throw all of this out the window, is the number of rate cuts that the Fed does. And by the way, just note this, please. Any forecast you saw that was made in 2024 for where rates were going in 2025, and I'm talking about Realtor.com, Zillow, Redfin, any of the major banks or institutional investors, they're all wrong because they were all banking on having 4 to 5 interest rate cuts for this coming year in 2025. And Powell said at his last press conference that he's thinking only 2. So that's one of the reasons the bond market jumped as high as it did. Everybody's off right now. Nobody's prediction is correct because the Fed changed everything. Now, what I always like to look at is jobs, because I think the jobs market is going to be what tips the bond market over to where the yields come down, which will in turn bring the 30-year mortgage rates down. So at this point, I want to share some data that I'm looking at, and I'll share my screen to do it. So things that keep the 10-year yield high are the jobs numbers right now. Jobs market is everything. That's what we're going to have to watch. So right now here in November, or actually this is December, if you look at where we get into the initial claims seasonally adjusted. So we're getting back down to about 218,000. You can see all the way up here in October, we broke 260, but now we're down to 218,000 for the initial claims. As long as that number stays around that line right there, the 211,000 number, then mortgage rates are going to remain high because the 10-year yield is going to be high. However, what we need to talk about is, things I look at is what's the spread between the job openings and the job hiring. So this is non-farm payrolls, everybody outside the ag sector. So you have 8 million total non-farm job openings at the end of November 2024. And then you had a total of 5.269 million hires, and you had 5.36 non-farm separations. That's people that quit, got laid off, or fired. So there's it's almost like everybody changed their job, but they didn't, because some certainly got laid off, especially in the EV industry right now. There's a lot of layoffs in the manufacturing sector side on that. And then we also saw Google just shed 10% of their management force and developer force. And, we're starting to see layoffs left and right, but the numbers keep getting tweaked to the point where it's not always shown. So that's what I want to show there. Now, let's talk about who's hiring. And this is important because Trump's coming in with his administration, and they've said that they're going to reduce the size of government, which, in blunt words, that means they're going to fire people left and right. We'll see what turns out. I don't know if they're going to be able to delete entire agencies and departments, but it's a pretty good bet that they're going to swing an axe and there's going to be a lot of job cuts. So this dark blue number here, 22. That's 22% of all jobs being created right now, job hires, if you will. That's government, whether it be federal, state, and local, with federal being the biggest part of that. The 58% right here is for healthcare, and with aging boomers and everything else, that's fine. That one's not going to get affected too much, but the 22% number is. You're going to boost, going back to our initial jobless claims, that number is going to get boosted probably north of the 260 number. That's probably going to go into the 300,000 and 400,000 number at some point. And then you're also going to have job openings come down because there won't be as many government jobs available. So that is what's happening on the job side that's driving the 10-year that is going to keep the mortgage rates high. Another place that I look at for interest rates, and I'm sorry I'm spending so much time on interest rates, but these are the main drivers for what's going on in real estate. The other thing I want to talk about is the spread. And right now, you've got the 10-year treasuries floating around 4. This is actually old. Right now, it's about 4.65, I thought this morning when I saw it. And the 30-year interest rate is north of 7. So as of right now, 7.10 is the mortgage rate for 30-year fixed today, which is January 7th, 2025. And the 10-year right now is at 4.59. I hit a high of 4.64 today, and it closed at 4.613. So we're at 4.613, and we have 7.10. So that's about a 2.5 point delta, what we call it the spread, between the 10-year yield and the 30-year mortgage. And historically, that's only been about 175 basis points, or 1.75%. At 1.75%, we'd be at 6.35, 6.34 versus the 7.1 we are right now. So if the spread comes down, that gives us some breathing room. And as the Fed cuts rates, that may give us some room, but the jobs number is way more important than that. So all that said, I guess the main point I'm trying to get through is if Trump is successful in cutting jobs at the federal government level, it's going to break the labor market, because the labor market is, by and large, outside of healthcare, supported by federal hiring, state and local as well to a certain extent, but the feds are the big driver on that side. So if they freeze hiring and start cutting, market's going to break on the job side. That's going to make the bond market, especially on the 10-year yield, start coming down, which will bring mortgage rates down, which will be great. And if all that does happen, then the 5.5 to 6.5 becomes a real number. But if it doesn't happen, then we're looking at 5.75 best case and 6.75 Worst case, once we get through this uncertainty going on that is created by the tariffs from Trump, once the bond market actually understands exactly what he's doing on tariffs, that will settle that back down below 7%, I believe, just by itself. The spread will come down a little bit as well, which will help. But the job market breaking is what will make any significant difference in the 30-year mortgages. So that's where I'm at on interest rates. We're saying 3 to 4 interest rate cuts again towards the back half of the year. And then also, if the labor market breaks, we get down to 6 pretty quick. Point number 2, we're going to talk about inventory. I do believe we're going to see more inventory this year as well, but again, incrementally only. I don't think we're going to see a huge flood. Now, the big asterisk I'm going to put on that is it depends on interest rates. If the labor market breaks, while the economy is still relatively strong because the Fed's quit hiring and they're losing jobs left and right, that would drive interest rates down towards 6%. Once we get to 6.25 or below, I truly believe all bets are off, and we wind up below 6, we're going to be off to the races in a huge way, and then you will see a lot more inventory. But at this point, I'm thinking we'll only see 5 to 10% more inventory total, at least in the Treasure Valley, Boise area. I don't know what's going to happen nationally, but increase in inventory, and that's about it. So there you have point number 2. Point number 3, buyers. We're definitely going to see more buyers. Now, if you follow our videos at all, for the last 8 years, I have been talking, actually 7 years, sorry. Ever since 2018, I've been looking at the demographics and preaching about how the year 2025 is going to be a watershed year demographically. We haven't seen anything like this since about 1977 to 1979, right in there as far as growth. That's when the boomers went through the same phase. Now Gen Y and Gen Z are going through this phase. And what that's happening is, you put Gen Y and Gen Z together, they're bigger than the boomers as an overall group on a headcount basis. The biggest subset of Gen Y and Gen Z turns 30 this year. So the biggest portion of that, you can call it the bulge in the belly of the snake as it's moving through, the biggest group of people within the Gen Y, Gen Z subset turned 30 this year. And that is, historically speaking, peak first-time homebuyer age. That's when you're forming, right around 30s when you start getting married, start having kids, or you buy your first house. So demographically speaking, it's a high water market. Now, you still have affordability issues. You still have the acquisition prices are high, interest rates, so the cost of capital is high, but you have more people now in that one. And if they get held up to where they can't buy it, the pent-up demand is still there. So I honestly believe that this is the year that the pent-up demand on the buy side is going to break through the 6% plus interest rate barrier that's been there holding everybody back. And you're like, I'm tired of waiting. We have kids. We need to get a house. And it's really important that you do become a homeowner if you have the ability to do so. Because I was just looking at something the other day in Fortune magazine that when you compare the net worth of people who have rented most of their life versus people who own homes most of their life, the difference in the net worth is 40 times greater with the homeowner than the renter, primarily because the equity in the house drove that, but also as you become a homeowner, there's more responsibility going with it. You get long. Once people see you own a house in the FICO module, that helps build your score. You get more credit opportunities that way. It's a complicated thing. I'm actually doing a 20-part series on the podcast, primarily for Gen Y and Gen Z and a little bit younger, talking about building your credit and demystifying some of this stuff. But building your wealth is very, very important, and home ownership has been the cornerstone in America for building your building your net worth for the last 70 years. So you definitely want to if you can. And again, demographically speaking, we have so many more people crossing that threshold of 30 years old this year that it's going to drive business more than what would have organically happened. The demographics are going to drive the sales. So that's a good thing here. To point number 4, which is our sellers. So with sellers, again, we're only talking about seeing incrementally more inventory, so we shouldn't see a ton more sellers. The things that affect sellers are always the top 5. It's the 5 Ds, if you will. You've got divorce. Somebody split the house up and take the proceeds and restart your life. You got diapers. You have a kid, you outgrow the house you have, or you go from a townhome to a house in the backyard, anything like that. So that does that. Death, that goes without really going into too far. You have, we do death, divorce, diapers, diamonds. That's household formation, people getting married, take care of that. And the fifth D is diplomas, and that's for empty nesters. They wind up with a lot more house than they need. The kids have moved out. But quite honestly, probably the last 6 or 7 years, we've seen empty nesters stay in place. Whereas the boomers, once they empty nested, they immediately or almost immediately sold their bigger house and got a smaller place. We're not seeing that quite so much anymore. We know plenty of empty nesters that just repurposed the rooms. Became a craft room, became a second guest room. Who knows what happened? But, we're not seeing the traditional empty nest behavior of selling the house as soon as the kids are out. So those are the 5 Ds that are going to drive it. So we're talking incremental increases only, and that's it. Unless that caveat pops up again, we hit 6%, get close to like 6.25 or less, then all bets are off. I think at that point we do see more people coming in to sell, and I think we see a lot more buyers come in, and that's going to raise the home prices some. And if it gets down below 6, I think we're actually going to see a mini COVID pop up again as far as prices jumping significantly, like maybe even 10%, and multiple offers on really desirable houses left and right. So that's where we're at on there. Point number 4, let's talk about our prediction on prices. So prices have been good. Last year, nationally, 2024 came up about 5.2% over 2023. And I don't know if it's going to get quite that hot this year. I mean, Boise area has been about 4.8% when you blend everything. 5.2 is kind of hot for the national. And there's a lot of stuff going on in Florida and in Texas, especially over by Austin, where prices are contracting. We're seeing a slowdown in California, which has been a big driver for the national number as well. So I'm guessing 2 to 3%, assuming rates don't break below 6.25. If they break below 6.25, 5% is a real number. Actually, going to be an easy number to hit. And quite honestly, if it gets below 6 into the 5.9, 5.8, 5.7 range, we'll probably see a 10% increase in numbers, in pricing going up for a median price, simply because there'll be far more demand than we're going to have inventory. And, that's what free markets do. When you have more demand than inventory, you have higher prices. When you have more inventory than demand, you have lower prices. It's pretty straightforward, but interest rates are going to drive that. So I think the golden handcuffs are still in place as a rule, because we talked about the 60% that, have 60% of all homes owned. They do have a mortgage on them, and it's below 5%. 40% of the homes have no mortgage at all. So your choices are, as a homeowner, assuming you didn't die, is that you can go from having no mortgage whatsoever to having a 6-point mortgage, or you can go from having a 3, 4, or 5% mortgage to a 6-point mortgage. It's an easier jump from 5% to 6%, but when you make a jump from no mortgage or from 3%, that's a big thing, because now you've got a much higher payment for less house, and most people don't want to make that jump. So that wraps up prices, our point number 5. Moving on to point number 6, we're going to talk about AI again and its impact in real estate. Last year we talked about how, hey, we're going to see it in copywriting, we're going to see it in data crunching and data gathering and credit approval for rent side, and all of that happened. So this year we'll see further embedded AI, and certainly in the copywriting, everything you see in the MLS, all the chat bots, when you try to type an answer, say, hey, I'm here to help you, it's most likely going to be an AI bot as opposed to a real person on the other end. But aside from the copyright, things like that, the art side got really, really good in the back half of 2024. And just right now, I mean, you look at GPTs on their 4th or 5th version of their engine right now. Claude.ai came out. They're very good on art. Grok over at Elon Musk's AI venture now. The artwork's getting better. It's not perfect. I'm still seeing, 6 fingers, 7 figures on a hand, things like that. But our predictions for 2025 in AI and real estate, not only are going to have the rent side where it's very involved there, and the copywriting, what the agents use for MLS, things like that, and the scripts that they use when they call you on the phone or when you meet them in an open house, that kind of stuff. It's going to go into conceptualizing the podcast content, the video content. I'm already seeing AI video editing where you pop it up there and the AI scans everything, drops in. When you're watching a video and you can see all the words, whatever the person's speaking, you see all the words down below. AI's gotten very, very good at that. And even when they make the glitches, it's very easy to correct that. So AI is helping in workflow areas that you used to have to pay for. Now, just as part of the paid subscription, a lot of those things can be taken care of far more cost effectively than hiring a videographer. We still use a human videographer, and we always will, just because there's things we like doing that AI isn't there yet, especially on our listing videos. They can't do the graphics or some of the angles that we get with our gimbals and with our drones and things like that. But we'll see it more on that side. I think you're going to see it more on the actual end video side. What you see, most of that will have been edited in AI for a lot of people. And I don't know on the buy sell side how far it's going to get into it as far as data crunching there and how the lenders are going to use it. I mean, I think they'll use part of it the same way that the rent side, the landlords do, as far as reviewing credit scores and approve go, no go. But that's always been kind of like that, because HUD's been using what they call the desktop underwriter, DU. When we talk to lenders about buyers writing on our listings, we ask, hey, do you have a DU approval? And that's been automated for as long as I can remember, to be honest. I mean, it was a very rudimentary program as far as you type in the income, the debts, how much their minimum payments on each debt was each month. That DU would pull their FICO scores, all three of them, from the three different credit agencies, and then they would mash it together, and you had a go, no go. Either yes, they are approved for the programs, or B, they are not. It wasn't like, oh, you're 80% there or 90% there. It was literally go, no go. I think that will get more sophisticated, and we'll probably start steering them towards specific programs best set up for their credit profile and their overall net worth and debt to income ratio and income, things like that. But that was typically done by the loan originator or somebody on their staff. I think AI will take over a little bit more of that. So we'll see. It's moving so fast, and the jumps that I'm seeing are so exponential now. There might be something it's going to do this year that I just have no idea that it even existed yet. So let's wait and see. But we are going to see more in AI, and not just here. We're going to see it everywhere. It's going to get so good, it's going to hurt graphic artists. It's going to hurt photographers. It's going to hurt videographers. It's going to hurt data entry. I mean, it's going to affect all of us one way or the other. So you can try to fight it, or you can try to embrace it, or try to strike a middle ground somewhere in between, but it's not going away. So let's talk about our next prediction and our final prediction, rents. So based on everything we're seeing, and I'm going to go ahead and screen share again because there's some data I'm looking at that I want you to see as well. So this is talking about single-family homes. And I want to focus on that one on this prediction more so than the apartments. My general view on apartments and multi-unit rentals is that they're contracting. The rents, and we can use this graph here. This is talking about single-family homes versus apartments. Apartments have contracted more than this have. However, you want to say, okay, here is 2019. So we'll use this as pre-COVID right here. All right, now this is year-over-year price change. So this is talking about the increase. This is not the actual interest rate, or not interest, I'm sorry. This is not the actual rent realized by the landlord. This is the percentage of increase. So if they asked for $100 last month, they're asking for, or last year, they're asking for 102%, $102 this year, that kind of thing. So you see here at COVID, it dropped, but then the rocket fuel kicked in with COVID, and then the rents just skyrocketed. And this can go back to, all the checks that came from the government during COVID to, help people out. And all of a sudden, people had all kinds of savings because they weren't eating out all the time. They weren't going to movies all the time. They weren't going to concerts all the time. They weren't taking trips because everything was shut down. Rents shot up because all of a sudden, people who normally couldn't afford to rent their own place, let's say, could, because they had so much stimulus money. That's what stimulus checks. Between the money they were saving by not going out and doing all the other stuff and the stimulus checks, all of a sudden they had enough disposable income that they didn't have to be a roommate anymore. If they wanted to go ahead and just have their own place, they could. And that's what drove a lot of this. So you see right there from 2020 up through the into 2022, then it died off because stimulus checks were done. And then as you scroll down through here, people started burning through their savings. The economy slowed down a little bit, and it came down. And again, these are the percentage of rent above ask. So these are the increases they're looking for. So right now, we're just under 2%. So it's almost at parity where we were in pre-COVID. And this is for single-family homes. And they have been the strongest part of all of these rents. So if they're coming down like this, then you would think that multifamilies are down significantly. This next chart here, this looks at some of the biggest markets we have. So you're looking at Detroit, Seattle, New York, Chicago, Washington. Well, urban Honolulu is not a big market. So I think they're just looking at deltas here from 2023 to 2024. Boston, Philly, Tucson, Houston, those are huge. Los Angeles is big, Miami's big. It's a good sampling of markets across the country. So light line is 2023, dark line is 2024. You can see that Dearborn, Michigan, no, Detroit, Michigan, sorry. But they're all right, so they're counting Detroit, Dearborn, and Livonia, Michigan. 5.2%. So that was the highest increase year over year, and this is going back to September. You go on the other side, Austin, Texas, which was a boom town just like Boise was, and their rents in single-family homes are down almost 3%. We're not seeing that in Boise. Boise's turned out to be far more stable than Austin has, and having spent 6 years in Texas, almost 7, I guarantee you a part of that is because so many people moved there from California and they didn't realize what kind of humidity, temperatures, and wild extremes they were going to be dealing with when they moved to Austin. So Austin got overbuilt, overpopulated really quick, but they also had everybody hitting the eject seat pretty quick as well. And that's reflected both in the contraction they've had in home prices, which we're not experiencing in Boise anymore, and the contraction in rents, which in single families we're not seeing here in Boise. Yeah, I'm not going to go too far into these. So for rents, what we're going to see is there's so many new units coming online. When I say newly constructed units here in Boise and Meridian and Eagle and especially in Nampa down south and Kuna, all through there, that rents are going to come down on new apartments, but the increases, like if you stay in your apartment, the landlord's going to hit you with between a 4 and 6% increase automatically, and you just have to make the choice. Do I want to move and get a better deal on maybe a brand new apartment, or do I want to stay, not go through the hassle of moving, and just bite the bullet and pay the increase? So those are the choices, but for new units, realized rents are coming down. For renewals, they're coming up between 4 and 6%. Just it is what it is. So that's where we are on rents. One other thing I want to cover on here, and it's really not a prediction, but it's more of good news is how I look at it. So when we're talking about who's moving to Boise, who's moving to Idaho, this is from United Van Lines. This is their 2024 48th Annual National Mover Study. What they do is when anybody they move into the state, and this is good for all 50 states, but I'm just focusing on Idaho right now. We had more people inbound than outbound. We had 56.5% inbound and 43.5% outbound. It goes through why they did it: 16% for jobs, 33% for families, 14% for retirement. All right, so that is what it is. The age ranges, it skews older. 64, almost 60, actually over 65% who came through are 55 and older. And that trend's been going for a couple of years. But here's where it gets good, because we're talking about income now. You've got, 67.7, almost 68% of the people make $100,000 or more. Some of those are retirees coming out of states like California, Oregon, Washington, whether they were cops or firemen or something else. They're coming in, they have a significant retirement income. So that sustains our economy. We still have Micron over on the east side of Boise. They're spending, $50 billion over the 10-year period that started a couple of years ago. They're bringing in a lot of high-end workers that are going to be making six figures, and they're going to be spending their money here in the Boise Treasure Valley area. That's great. There's all kinds of construction as we drive all over town. It's not just one sector, which is beautiful. You've got the tech sector growing, you've got services growing, you've got more hotels going up, you've got more restaurants going up, you've got more manufacturing going up. We have a couple friends in commercial we talk to all the time, and on warehouse spacing and also on manufacturing space, they're seeing a huge demand on that, very little vacancy. So all of these bode very, very well for the future of Boise's economic window, which also bodes well for anybody who is a homeowner or anybody who wants to buy in here, because there's good economics, your salary's good, your job will be safer, and there's a better chance you can buy the home. So all in all, I see nothing but a lot of good news here. Now there are certainly Idahoans we talk to, especially multi-generational Idahoans, who, have seen home ownership slip out of their grasp, and that's sad. There's no two ways about it. I wish it didn't have to happen like that, but it's the reality. And where I'm from in Florida, same thing has happened. It was once the most affordable place around, and now not only is it not affordable, they're actually especially Southwest Florida, they're contracting price-wise. It's slowing down immensely. My mother passed away early in 2024, and my siblings and I sold her house mid-year. And I'm glad we did, because if we had to put it on the market now, we'd take a lot less money than we did before, and it would take far longer to sell it. We had somebody buy it, they gutted it and remodeled it, and they put it out at, I think, $500,000. And right now, the last time I looked, they're down to $445 and still no buyers. And they did a pretty decent job on the remodel, which is on a golf course, on the ninth hole of a golf course, in a very nice gated community. But that house 7 years ago was probably $210,000, $220,000, depending on where you live in the market in the country, as to how well it's going or not going. But for Boise and for the Treasure Valley, we're very, very encouraged by what we see. There's no secret in all of our videos. We tell you how much we love living here. It's fantastic. It's heaven on earth as far as I'm concerned. There's great outdoors. There's great indoor stuff. It's funny. Kirsten and I picked up playing pickleball this year, or 2024, last year, with Kaitlin. And it's the only thing we can do year round, because there's a facility we're members of over at the Flying Pickle in Meridian. And it's great, because in the summertime it's air conditioned, not sweating to death. In the wintertime it's heated. I mean, literally, we walk out of the house in t-shirts and shorts, go drive over there, walk across the parking lot, go play our games, come out and come home. But it's great. It's one of the things we can do all year long, whereas all of our other things like mountain biking, skiing, the paddle boarding, swimming, whatever we're doing, kind of depending on the season, what's going on. Yeah, there's our top 7 predictions. Future is bright. I had to wear some shades. I don't have any up here. I would have put them on right there. That would have been funny. So there you have it. Now, if you disagree with any of these predictions, which I'm sure certain people will, drop it in the comments. Let me know where you think I'm wrong. If you think that I missed something in 2007 or 2024 I should have been talking about, let me know. And if there's something else you'd like to see us make a video on, drop that in the comments as well, because we are going to go very, very heavy on video this year. We're going to produce a lot more content than we did last year. And we want to make sure we're building things that you want to see. I say building things, making videos you want to see and watch. We're certainly going to do more day trips with the Jeep and show you some great places to go see around here. Matter of fact, in the Better Homes and Gardens magazine that 43 North puts out, I believe we've got a issue coming out this month where Kirsten and I laid out 3 day trips. We talked about Silver City over there in the Oahe Mountains south of us, Idaho City, which is north on 21, and then also Placerville, which is just past Idaho City, with a fantastic cemetery. All of those places are fairly easily accessible. You don't need a giant high clearance vehicle to get there, and they're all worth the trip. They really are. So there you have it. If there's something you want to see that you think we could do a good job on, let us know. We will be happy to produce it. Short of that, thank you for watching. We'll see you on the next one. Bye. Thanks for listening to today's episode. If you would like more info on how we provide concierge service to our sellers, buyers, and investors, give us a call at 208-872-8108 or send an email to sold@thepowellgroup.com. We don't just help people with homes and investment properties, we know land as well. With hundreds of satisfied clients and over 4 decades of experience, our team will help you move on with your life in no time. You can also find us all over the web and social media. Just remember that it's MoveMe, the number 2, Idaho, when you are looking us up. Thanks again for listening. We'll see you next time.